Hi guys, Sean here. This is a video that I thought I would update. This is a wealth plan template that I've created in 2018. It's still quite valuable, even though it is quite a few years old now. This is just basically a tutorial video of how we look at property when combining your traditional investments, which is things such as pension funds, retirement annuities, share portfolios, tax-free savings, endowments, crypto to some extent if you are looking at crypto. But essentially the objective is you want to see how traditional funds combined with property, which is rented out, can be used together when tracking an investment goal. So this is just a hypothetical example of a client, John and Jane Appleseed. They're married. Tamlin is the chartered accountant that prepares the plan. I created this plan in 2018. Tamlin and I work very closely together to assist investors when we updating information. But essentially what we want to do is we want to see, using a financial model of forecasts, how can a client's portfolio benefit by having investment property added to their portfolio if they add rental property to their existing retirement funds, in other words, their pension funds, etc. So this example I'm going to use is a husband and wife. They're looking to plan together. I've just zooming in. I'm working on John, who's slightly older, as you'll see. He's 31, wants to retire at 65. 80,000 Rand is the income he wants to receive in today's terms. The future income at retirement is 580,082 Rand, which is adjusted by inflation. We're saying is 6 years. And we're saying the income needs to last 25 years from his date of 65. So let's first get onto that. Here is John and Jane in a bit more detail. John 31, Jane 30. They're married. ANC with accrual, who's a software engineer. She's an environmental officer. He wants to retire at 65. They want 80,000 Rand at retirement combined between the two of them. And they want the income to last 25 years. So the first thing we need to look at is 80,000 Rand in today's terms will not have the same buying power when they get to the date of retirement, simply because of inflation and the buying power or buying parity of the buying parity of the income will change according to the cost of goods and services. I'm not putting tax in. We normally can't put in tax in. Let's say if the tax rate was 15% as an example, it'll push the gross desired. But basically what we'd normally do is we'll take 80,000 divided by 2 and work out the average tax rate on 40,000 Rand so that we can say that each will get 40,000 Rand as in today's terms, but we'll adjust that by inflation. So by doing that, we take 80,000. So John 31 wants to retire at 65, 34 years to retirement. He wants 80,000 Rand in today's terms, which is 960. And that by adjusted by inflation is 580,082 Rand, which we've really pulled through from the summary section over here, which is just basically linked. And what we now make the assumption on is that the income escalation retirement is 6%, which means it's 80,000 adjusted to 580,082 needs to escalate at 6%. We're saying that the capital in retirement is going to grow at 10%, and the capital prior to retirement is going to grow at 10%. And this is assuming that it's after fees, it's in a balanced portfolio with a lot of growth. In other words, high exposure to equities, etc. Inflation 6%, and we're saying salaries is 6% because that does impact your pension funds, etc. Because generally speaking, your pension is a percentage of income, and your salaries are growing at 6%. Your pension contributions are increasing at 6%. So the first thing we need to look at is 580,082 needs to pay out for 25 years, escalating at 6%. If income can grow at 10% whilst in retirement, he would need 150,598,500. When I say yes, actually they, sorry. John and Jane would need 115 million that be grown between now and retirement so that they can draw 80,000 Rand equivalent in today's terms, which is 580,082. Now, if they don't get the 9%, so what we need to say is if they don't get the 9% growth per per annum. So in other words, if I don't get the 9% over here, that means if I make one assumption and say, if their money doesn't grow at 9% in retirement, they want to be a bit more conservative and say, we want to go into a more moderate fund or funds so that we don't put too much exposure, the volatility is lower. That means that this amount escalating at 6%, growing at 9% now, would need 127,034,792 and not 115 million, because now we've made one assumption. That's not a problem with investment planning, is that if your funds are not growing or there's high fees, etc., you're looking at quite a big difference. Let's just work out that quickly. So it's 127 million. We'll just work it out to my calculator, and you're welcome to do the same on your side. If we take 127 million, 34,792, and I go and change this back to 10%, and I minus 115, 598, 500, that's 11 million rand difference. Now, obviously 11 million rand in today's terms is a lot of money if you adjust it by inflation, etc. But still, 11 million rand is a lot that one needs to grow by making one assumption change, which is the growth in retirement. So that's the only downside of planning for retirement in funds. And secondly, after 25 years, this money fully depletes, which means that this 115 million will be fully depleted when John is 25 years older after 65. So John will be 90. So we're assuming John is 90, Jane will be 89. This will be completely depleted to zero. So we're hoping that they do not live longer than age 90 is what I'm getting at. So that's the starting point, 115,598,500 to get an income of 580,082 paid out for a period of 25 years, escalating at 6%. If they can get a 10% growth on their money in retirement, then they'll be able to live until 90 before the money runs out. So the next thing we need to look at now, we first established that he needs 150 million. So now we need to see, okay, so what is John and Jane's portfolio? They've got an array of investments here. A lot of them don't have contributions. It's got 2 preservation funds. It's got a retirement annuity now of 6,000. We've saying everything is going to be included in the retirement. We can turn some of these off. And we've made the assumption already that the capital is going to grow at 10% prior to retirement. So all these investments are going to grow at 10%. Now, what this basically means is we then break it down. So you've got, this is the breakdown of his portfolio, the different companies, just a nice little pie chart. But then we can see with escalating funds, it's got a retirement annuity of 193,000 and the contributions per year is 72. And we're saying the contributions are escalating at 5%, which I've just indicated over here. So it's a bit conservative. Most investors will make it 10%, but realistically speaking, if their salaries are not growing at 10% a year, it does eat into their budget. And I've just made the assumption they've got quite a large amount that has been put into funds. He's maybe changed jobs and things like that. He does have share portfolios where he's putting money into that. He's not necessarily investing every month. He's got a tax-free savings, each of them of 3,000, and he's got a share portfolio. So essentially what we're looking at here is just a snapshot of their portfolio. This will be updated every single year. That's where we can see how the fund values change. We can also look into the types of funds they're in, if they're in balanced funds, etc. But generally speaking, we work on the assumption over that period of time, unless they're in a more conservative portfolio, that 10% would be the benchmark. And that's just where they can speak to their financial planner in more in-depth analysis. Where is their money invested? How is their investment doing? In other words, how was it performing? So now if we look at the 72,000 contributions, this is into the escalating with the retirement annuity. Non-escalating is 72,000, which is the tax-free savings. And this is the breakdown. So they've got 2.1 million rand in total, which is all the fund values over here. 2.1 million. And then you've got the annual contribution, which is the 72,000 over here. So what the idea behind this is is we want to see what is their current position, which is 2.192193607, which is the total portfolio. So basically, if you add these two together, that's how much they have currently in funds, and it's the total contributions they're making per year. Obviously, a financial planner would give them recommendations, etc. That's between them and the financial planner based on their relationship. But this is the snapshot that we take every single time. We pull an astute download, we get information from the asset managers if we need to get information such as the investment statements, and we just put in the information over here. And if it's escalations, we do put in the escalation amount and work out an average. It's not going to be exact science because it does change, but also it's very difficult to project future values of these investments because we don't know if the client's going to keep them. We don't know if the client is going to change jobs and maybe put that in preservation, no longer contributed towards the fund anymore. As you can see over here, in this case, there's quite a few funds that don't have contributions. So it's quite difficult to keep track of that without, over projecting in terms of using an exact growth rate per fund. I do have a more advanced template that you can do that with. You can put in all your investments. You can put in the types of fund they're in, and you can also put in the growth rates as well as the escalation rates per fund. That's a more detailed template that I've got specifically for this type of forecast, which is the traditional funds. But in this case, I'm just working on average here. There's no escalations because it's a non-escalating premium. So it's 3,000 Rand per month, 36,000 a year. And these are just growing at the 10% as we've already used as an assumption, including that. So if we take all these values here, grow 10%, he'll have a future value shortfall of 5.5 million. So the total future value is going to be 110,069,776 based on this portfolio growing at 10%. These contributions escalating at 5% and these not escalating. So in today's terms, that's 216,412. So if John and Jane had a 216,412 and they invested that amount and grew that at 10%, they would get to the 5.5 million. So in this case, it's actually not looking too bad at all. It's not a bad portfolio. And the main reason for this really is because they've got 34 years to retire. This picture would change if I were to go and say the desired retirement age, let's say it was 60. 60 over here. And I'll go back over here. It now goes to 19 million because now we want to assume John Jane wants to retire 5 years earlier. That's the implication of the compounding and also the additional contributions that they're no longer going to be making. So now they need to have an additional 19.5 million, which in today's terms is 1.2 million. So as you can see here, it's really difficult to plan a traditional funds, because as soon as you change any assumptions with regards to age, income, growth rates of funds, escalation of income, it changes the entire model, which makes it very, very difficult to plan as a financial planner. But just I'm leaving it for now. Again, also, if I were to go and change this now and say prior to retirement, it was 9%, it's quite massive. It goes to 30 million. Just put it back on 10 quickly, because that's 34 years of compounding that you don't get that extra 1%. So I'll just show that again. If you were able to get 10% growth in your money compounding over 34 years, it's a 5.528 million shortfall. But if you only got 9% compounding over 34 years, it's 30 million. So that 1% compounded over 34 years does make a substantial difference. So if I'm being honest, I think the 9% prior to retirement might be a bit more realistic based on financial markets, etc., or just to be a bit more conservative. But I'm going to leave it on 10% for now, just to illustrate where property fits in. So we can see now they've got a 5.5 billion, assuming that they can achieve these, or this rather, the 10% growth prior to retirement, which compounds annually. So now where we look at property is we now can then take their property portfolio. We're going to assume that these properties, just going to put this into the company as well. They've bought a number of properties across South Africa. These are two in Gauteng and one in the Western Cape. These are all investment properties, which means that they're going to be rented out. These properties were bought at different dates. These are the purchase prices for each of them. This is the deposits they put down, initiation fees. We try and capture as much information as possible, such as bond terms, registration dates, the loan to value, which banks they got the finance with, what is the outstanding bond at that moment in time when we are evaluating their portfolio, what is the market value, which you try and get from Lightstone and Property 24. We take the current rentals in their portfolio. If there's any rental assistance, we also put that in, which we track over here. So when the rental assistance falls away, we obviously don't put it in anymore. We are saying that the escalations on their rental is 6%, so it's sort of in line with inflation. And at this point in time, we are saying that the levies rates are also growing at 6%, which we can also monitor on an annual basis. So what we then do is every year, we update the rates, we update the levies, update the rates. The rental management fee is generally a percentage. It's 11.5%, 11.6, 11.5, and 6%. That's just made up at this point in time. And then we can see what their total shortfalls are. So they're making 9,904 Rand contribution into their property. And that's now where you can start seeing, okay, so I've got 6,000 over here, 3,000, 3,000. So they've got basically 12,000 going into the investments. And with their property, they've got 9,904 Rand, which they're going towards the investment. Now, if it's a primary residence, we can also track a primary residence over here if they did have one. There's also holiday home, which generally doesn't rent it out. It's just, we check the bonds, etc. Because what we want to do from a cash flow point of view is we want to see if these bonds started now, in this case, 2018, one started this year, one started in 22, 21, and they've got 20, 30-year bond terms, and these are the number of years that have passed. We want to track from an investment point of view, when are these properties going to firstly break even? And secondly, when are the properties actually going to be settled relative to John turning 65? It only goes over here to 60, but that's actually not the correct one we are tracking. This is what it looks like over here. So there's a lot of back-end formulas. So what we basically do is we take John's age. So this is the year after 65. And we track all the future cash flows into his retirement per property. So we can do it across all four, and we can do this up to a total of 20 properties. So we can track 20 properties on this template and use the forecasts to accurately measure what is the cash flow going to look like on each property based on the rentals growing at 6%. The levies and rates growing at 6%. Obviously, the bond installment remains the same, and that's based on these variables. Just note the prime lending rate at the time that we did this was 10.5%. We can change it to 11.75, which is what it is currently at the time of this video being recorded. And then the installments will then change. So you can see it's now obviously going to change to 12,000. So you can see now, obviously, the interest rate has impacted their contributions, but we are anticipating that the interest rates will adjust as the repo rate is brought down by the Reserve Bank, because the inflation is within the target band prior to the COVID pandemic. So, as I say, we track everything on an annual basis, and the objective here is, if this is what the shortfalls are currently, we want to know, what is this portfolio going to look like when John's at 65? Because obviously these properties need to be paid off to benefit from the cash flow of a paid off portfolio. It's just snapshots of the break-even ratio. So this property is at 74% or 75% rounded off, 77, 69, 56. And as time goes by, these properties will near closer, and you can see the number of years here. these properties, some of these values have not been updated, but also you've got 100% finance on that one. So that's probably why the break-even point is a bit longer. But we obviously then track the cash flow and see, okay, in 8 years, this property will break even, 12 years, 14 years. Bearing in mind, he's got 34 years to his date of retirement. So he's got plenty of time to pay those properties off using the tenants to cover the bulk of the expenses. And within 8 years, they will break even, so it'll start running and paying for itself. So that we then do is we then say, okay, well, if this is the income now, and we adjust this by 6% and do the same across the board, across the 4 properties, this is what the future incomes can look like prior to deductions. You'll notice here the bonds have all settled to 0. Why? Because he's retiring in 34 years. He's got a 20-year, 30-year, 30-year bond, which means that these properties all would have been fully paid off by the time he gets to his date of retirement. If I were to change his retirement age to 55, you would see here that then there's some bonds running because they're 30-year bonds and not 20. So I've got built-in formulas that will automatically determine whether or not the property is still running based on the bond term. So that's quite important, because obviously if John's 55 now, this is what his cash flow is going to look like. He's going to get 49,309 Rand surplus from his portfolio. But if he retired later and gave himself another 10 years to plan, he would then have 127,898 because he doesn't have those bonds anymore, which we saw prior to changing the age to 65. So this is what we're tracking to see what the net income is going to be. Now, this is important because 127,898, we need to compare that to the 580,082 because that's the future income of 80,000 adjusted by inflation over 34 years. So what we then do is we take this amount over here. It's just a snapshot of his portfolio. So this is the current contributions. This is the total bonds. This is the total shortfall because obviously the rent is covering the balance. His RVR or rent to value is currently 0.78%, which is not bad. His average net yield is 6.38%, which is slightly higher than inflation. Average growth rate, we haven't adjusted this really on this particular example. This is the gross income at retirement and net rental income portfolio fees. So this is the 127 I was referring to. And then this is the Section 13 deduction. You need to have 5 properties for that to count. So that's what I'm not going to discuss in this particular example. But Section 13, you've got the calculation over here. Here's the 92,232. This is the market value of the properties based on these assumed growth rates. The assumed growth rates of the properties we are saying is 5%, 1%. So not a lot of growth. Some of these properties are still fairly new. They haven't had a chance to appreciate yet. And obviously, at the time we did this review, we still have to update this information, which is why these figures won't be 100%. But this whole point of this exercise is to illustrate to you how this works. This is the total opportunity cost, 245,400, which you can see is taken from over here. We've got all the formulas, sum if, count if, a lot of formulas working over here to sum up this table just to show you what's going on. And then what we then do is we then can plot the 127,898. We divide it by the 580,082, which is this amount over here. And we can see that this particular portfolio is going to give you 22% of this income in the future, which means that 22% of his properties is going to contribute to the 580. And if we look at his traditional funds over here, we've already said that it's got a shortfall of 5.528 million. And if we plot the 52528, plot the future value, we can see where that 5.5 million shortfall comes in. So we're saying the money needs to last 25 years. The future income is 580,082. We're saying the growth is 10%. I'm going to change this to 9% to show you the other side of not getting the returns you need. Escalation in income is 6%. And we're saying the money needs to last 25 years. So if we now take the 110 million, we take the annual income, which is this amount over here, the 110, and we times that by sorry, the 580, we times that by 12. That's what the annual amount is going to be. We take that minus that, gets you to the balance, plus the growth, which you're saying is 10%. And we carry and do the same example, and this is what the drawdowns are going to be. So now we can see more or less how long the funds is going to last. In this case, we're saying the fund's going to last 23 years, and they need the money to last 25. So there's only a 2 million rand, 2 years of shortfall, not having income, and that's where that 5.5 million comes in. Now, if I go and change the in retirements to 9 and go back, you'll see here that now has a 5-year difference, not a massive difference, but it's 20 years versus 23. And this is how the income is going to last whilst in retirement based on the annuity drawdown of 580, and that obviously increases by 6%. And the objective behind this, I'm going to leave it on the 9% for now, just be more conservative because of age. If we now take that and say, okay, well, if I'm getting 20 years on my funds and I'm getting 22% from my property, what would happen if I draw 22% of my property and the balance from my investment? In other words, instead of drawing 6.9 million, you're going to take this amount times by 12 and then only take the balance from your pension. So we can actually illustrate that over here. So here's the 6.9 income, which is taken from the this is the 580 times 12, which we've already seen is taken from over here, taking exactly the same example. The 1110 is the future capital. Then we take that, then we take the annual income, which is the amount we already established over here, which is 127,898 times by 12. And we then say, okay, well, if we take the desired income and we minus the rental first, and then we apply the balance to minus the balance of your pension or retirement money, you're actually going to start having a higher balance at the end of the year. So I'm going to show you, it's 104 over here versus 103. And obviously because we're taking the money from the property. So your annual drawdown actually reduces. And in this case here, instead of having 20 years, you're going to have 29 years before your capital fully depletes. And the reason for this simply is you are supplementing a portion of your retirement funds so that the property can obviously provide you with a portion of your retirement. Now, this is quite important if I go and change this to 9% as well. So now if we don't get the growth in your money prior to retirement, you can see here that it's 20, let's say it's 21 years with property drawn, or 22% from property, I should say. And without property, it's 15. So where it's quite important is if you don't get the target returns, say you get a 9% and not 10, and we are tracking property at 6% escalation in retirement, 6% escalation in rentals, and growth of 9% in your money, you're going to prolong your capital by an additional 5 years by having 22% from your properties. And the objective here is, if you're looking to break even, let's say 8, 12, and 14 years or whatever, if this investor decides to reinvest, and I can show you what I mean by that, if he decides to reinvest some of his capital here by refinancing this bond, this portfolio, and taking money out and putting it down on future properties and buying additional properties, or he puts the money back into the existing bond through the access facility and he pays the bond off sooner because he's settling the interest payments a lot quicker, then this client could potentially pay the properties off and live off that money sooner or whatever. Or this person could reinvest their equity into further property to improve this replacement of income. So they're getting 22% of the desired income at retirement through 4 properties that are fully paid off. And this, the average purchase price is 838,000. So we're just going to put in 838,000 over here. And I'm just going to put in, let's just say 7,500. I'm going to leave the expenses off. I'm just going to put in just something similar over here. I'm going to leave the rental management off, etc. I just want to illustrate my point, is that if you add one property, it says 30% rounded off. We've already said that prior to that, the money would last to 21 years. It now takes to 24 years. We already said without property, it's taken it to 15 years. So we are now prolonging the property, the retirement funds even further, because you're now essentially prolonging your capital by relying more on your property portfolio. So 30% is coming from income from rentals, 70% is coming from investment. So you can see here your annual drawdown, it increases at a rapid rate compared to over here, where it's not as much. It's a gradual drawdown, and eventually the money depletes when the client is 21. So that's kind of the premise behind why we would look at investment property as a retirement vehicle in addition to funds. Now, of course, if we were to go and get now, let's say the target return whilst in retirement, let's say it was 10%, and we then looked at the picture, then that money would last even longer. So instead of being, it's now 16 years, it's grown 1 extra year. They're making a massive difference. So the point is, you can play with different scenarios of how the investment would last based on growth rates, etc. And if you're going to get better returns, let's say you go into prior to retirement, you're going to go into a 12%, you're taking a lot more risk, 9%. How would it look? Then it goes into perpetuity. So in this case, if you were to achieve before retirement, which you can see over here, if you were to get 12% return in money after fees, so in other words, you go into a very aggressive portfolio or limited to Regulation 28 in retirement funds, this person would have quite a big surplus. And obviously, because 12% compounded over 34 years would be a very, very good investment, simply put. Let's just say that was the case. The money would last. Okay, well, in this case, you actually wouldn't need property because the funds would not run out. But again, 12% prior to retirement is a very tall order to achieve, especially in today's market. So a bit more conservative. But the point is that just by adding one property, you've gone from 22 to 30%, so 7% increase in income, as an example. Obviously, if there's a bond, etc., but we can assume it pays off beforehand. We can then see the impact of modeling that. The property added now would put that into perpetuity, and without property, the money would last 21 years. Now, again, the idea is that we want the money to last longer than they are while they're alive. So we're just making provisions that should they live longer than 25 years, they've got at least additional income because it's been prolonged. And that really is how we would look at property, through leveraging with the banks, having tenants pay all the properties off over time, annualizing the portfolio, looking at opportunities to potentially expand their portfolio so that they can benefit from, utilizing the bank to help assist acquire further properties to refinance the equity in the bond. And in this hypothetical scenario, this is how much equity is currently sitting there, is 575,000, which is captured over here. So they've got enough equity to potentially refinance the portfolio if they're in a position to do so. And that can be used to put down deposits tax-free into further properties, which I've hypothetically said they've bought one for 838,000. It said they're getting 7,500 rents, and this sort of levies and rates, and this is the income they would get. This will get you to the 30%. So a property, whether you buy 1 or 5 or 10, whatever. Everyone's circumstances are very different. This case does work favorably because it's 34 years of compounding in their retirement towards their portfolio. But obviously, the older you become, you might rely more on properties because you get to a point where, regardless of how much you contribute towards your funds, the lump sum that you require is just too great for you to accomplish. Now, I've just made changes over here. I said 10 and 9%. It's now got a 60 million shortfall. I've just changed one assumption over there. That's 20 years, as I said, with property into perpetuity, because you're getting 30% from your property, 70%, instead of having 100% from your pension, which obviously depletes it at a much faster rate. So yeah, this is essentially how we would model portfolio. Typically have a conversation around a person's portfolio. There's absolutely nothing wrong with going into funds. There's definitely benefits of doing so. There's rebates you get from retirement funds. There's tax-free savings, so there's no tax on interest that has been generated. Obviously, having savings is great, but not everyone's in the same position as John and Jane because they're still relatively young. They've got quite a large portfolio, as we've already mentioned over here, 2.1 million over here, combined with 2.3. Not many 30-year-olds are in that position. So that's why everyone's portfolio would be different. And we can even drill further if we need to see how the properties are performing. We've got some extra sections over here that can look at the properties per province. What is the growth rate? Because obviously we got the market value at that time, and we can then compare it to the purchase price. How much has it grown? Hypothetically, the properties in Gauteng have grown 11%. The ones in Cape Town is 2.2. In reality, it might be the other way around. What is the percentage of portfolio per region? We can even do offshore if we need to. If a client's got investments abroad, we can see what that is and just convert it into rands to see what it's grown by. This is current market value. Obviously, I've added an extra property in there to get it to 5. But then we could just see here. Let's just quickly show you. If I go and change this to an offshore one, investment property over here and offshore. Let's just see if it pulls through. And you can see here's the offshore property. So we can check as much information as we need to just to see what's going on. We can also see what's happening with regards to capital gains, what's in the trust, what's the company, because there's different capital gains tax rates. That's if a client is potentially looking to sell property that is not performing. That's where we can do analysis of their portfolio. But really, at the end of the day, we want to try and do some number crunching so that we can get you as best possible to this sort of outcome, so that you know that when you get to retirement, you're not going to be relying solely on your pension, retirement funds, etc. You do have at least a backup. Just note, I have made a note here that if it's compulsory funds, which is your retirement annuities, your pension funds, etc., you are limited to 17.5% drawdown. I don't have that factored in here. It is on my other template that you can purchase. The main reason for that is because we don't want your money to deplete at all. If we can get you to a position where you're drawing so little from your funds that, in this case, for example, you're only getting to 17.5% at 91, if this was a purely retirement portfolio. Instead of, without property, you're reaching that over here at 80. So we are prolonging your money through property, which is what you want, so that your retirement funds will never be an issue. So if you are drawing down well below the 17.5%, it's going to last longer. That's the objective behind this exercise. But if you don't have property and you just want to see how your pension fund's going to do based on the drawdown, that's what the other template can be used, which you can purchase and use to see how long is the money going to last between 2.5% and 17.5% when you actually factor in your own portfolio. But this is all done for you by a chartered accountant. I then have a conversation, go through everything, look at the assumptions. We can make changes if necessary. But this is how this template can be used to effectively, hopefully, add value to one's portfolio. Other things we'll look at is just the structures to purchase properties in. Essentially, this is the latest one, the latest tax table, transfer duty. This is the tax rates on individuals. That's obviously income derived from the properties, capital gains tax. This is just basically just estate planning. This is the recommended structure. It's something we'll discuss in the in a conversation. We might bring in our trust attorney to have a conversation regarding the services we provide. But this is just a nutshell of how this works. Companies have a low tax rate than other entities. That's why we would recommend a company. And the trust basically acts as a vault to separate ownership of assets compared to your assets in your personal state, which obviously not in trust, that are owned by you in your national capacity. So this is hopefully something that can better explain how we look at retirement planning through the combination of the two different models. If you want any heavier questions or like to have a demo, please feel free to reach out to me and we can have that arranged. Just to hopefully add some value. This is clearly designed to open your eyes in terms of how retirement planning works and how the different models can be applied effectively. And then we slot in where necessary to help you make more informed decisions. Thanks very much for taking the time to watch this video. Hope to make another video soon. Thanks for now. Ciao.